Welcome everyone to our webinar on getting Brexit ready in relation to indirect taxation. My name is Lee Squires. I'm a tax director based in Grant Thornton's Belfast office, and I lead our Northern Ireland indirect tax practice, advising clients on VAT and customs duty issues. I'm joined by my colleague Stephanie Smith, also from our indirect tax practice in Belfast. We're going to cover the implications of Brexit on customs and VAT, including the special considerations that apply for goods moving across the border between Northern Ireland and the Republic of Ireland, customs special procedures and reliefs, the impact of Brexit on access to the EU's free trade agreements for UK businesses, and what businesses should be doing now to prepare for Brexit. To begin, it is worth recapping what the status quo is. So at the moment, if EU goods move into the UK, the border is entirely frictionless. There is no customs duty and no adverse VAT cash flow. At present, if goods move into the UK from outside the EU, then an import declaration is required. There could be customs controls and inspections, and customs duty and VAT would be payable. So now let's turn to consider how things could change following Brexit. So in this presentation, we're going to assume a no-deal Brexit on the 31st of October. So that would mean that there's a cliff-edge change on Brexit Day with no transitional period, and trade between the UK and the EU will be on third country, or so-called World Trade Organization WTO terms from the 1st of November. This would mean that goods are subject to customs processes and controls and customs duty. There could also be double duties on goods moving across EU and non-EU borders multiple times. UK businesses who have only traded with the EU will need to devise new systems and bear new costs to deal with this. The UK businesses will also lose access to the European Union's network of free trade agreements. As at the date of this recording, the EU and the UK have agreed a revised withdrawal agreement. Now, this must still be approved by the UK and European parliaments, and if it's not agreed, then we will still have a no-deal Brexit on the 31st of October unless the UK and the EU agree an extension to that date. If the deal is approved, then we will move into a transitional period which will last until at least the 31st of December 2020. During that period, effectively everything remains the same. The UK continues to follow EU rules and is treated as an EU country for most purposes. Under the new deal, the UK is seeking a free trade agreement with the EU, which would apply from January 2021. The new deal includes a new protocol on Ireland and Northern Ireland. Under this new protocol, the goods moving from Great Britain to Northern Ireland could be subject to EU tariffs unless they're identified as only being of low risk of crossing the Irish border into the EU, broadly speaking. But the importer can reclaim any duty, and Northern Ireland will also be obliged to apply EU VAT rules. So you can see that even under a deal, there will be changes to the customs and VAT environment in the UK and Northern Ireland. So returning to consider what would happen in the event of a no-deal Brexit, we're going to look at the general rules for EU and UK trade first, and then turn to look at the special rules that could apply in relation to the land border between the UK and the Republic of Ireland. So in order to import and export after Brexit, you will need an economic operator registration and identification, or EORI number. HMRC has allocated those automatically to most businesses that trade with the EU, but if for some reason your business doesn't have one of these numbers, you should apply for that now. Import and export declarations will be needed for each consignment imported from or exported to or exported from the UK, and businesses need to consider how they will comply with this. Most will use a customs agent or freight forwarder, but if you would like to do this yourselves, you will need the special software to communicate with HMRC's Customs Handling of Import and Export Freight Chief System, an authorization or so-called badge to access that system and train your staff in completing the declarations. But fortunately, as we will see, HMRC have introduced something called Transitional Simplified Procedures, or TSP, which allow you to defer the time at which you submit these declarations. So it should also be borne in mind that some imports and exports are subject to licensing or other restrictions. Broadly, where goods move from outside the EU into the UK, an entry summary declaration, or also known as a safety and security declaration, is required. But the UK has said that these will not be required after Brexit on imports from the EU for a period of up to 12 months. So the Transitional Simplified Procedures, or TSP, allow the deferral of import declarations and customs duty payments for up to 6 months if there's a no-deal Brexit. As of this week, all eligible UK-established VAT-registered businesses that import from the EU have been automatically enrolled in TSP by HMRC. Again, if you don't receive a letter to this effect in the near future, you should check with HMRC whether you need to register. If you wish to defer duties, you will also need to apply for a duty deferment account. For most goods, known as standard goods, the procedure under TSP is as follows. You have to make a simplified import declaration in your own commercial records on import. And this record has to be updated once the goods have arrived in the UK. And then you make a supplementary declaration, which is deferred until the 4th working day of the following calendar month. And the payment of duty is deferred until the 15th day of that month, provided you have a duty deferment account. The recent announcement is that you can choose to initially defer your declarations until the 6th of May 2020 and payment of duties until the 15th of May 2020. So that's effectively a 6-month deferral. So that gives businesses a long time to prepare to make customs declarations and pay duties. So you only need to worry about making the simplified import declaration in your own commercial records initially. Controlled goods, which are those goods subject to excise duties or import licensing, follow a slightly different procedure. There must be a simplified frontier declaration made to HMRC on import, but thereafter the process is similar to the standard goods process, so there's a deferred supplementary declaration and payment of duty in the following calendar month. For exporters will also need to submit export declarations as with import and consider whether they will do this themselves or use a freight forwarder or customs agent. If you wish to take responsibility for importing into an EU country, for example, perhaps because your customer wants you to deliver a duty-paid product, then you will also need to consider the import formalities and any customs declaration needed in the EU country of import. Of course, the main impact will be the actual tariffs that are payable. That is the purpose of the customs processes. So if you're exporting to the EU, that's an import into the EU. So the tariff payable is based on a commodity classification system known as the combined nomenclature, which requires you to determine the 10-digit commodity code relevant to your product. And the duty, the corresponding duty, that tells you the corresponding duty under the EU tariff. Now this is not always straightforward. It can be complex, particularly where there are multifunctionary products. And we suggest caution in assuming that the codes used for intrastat purposes are correct. As these are currently only used for statistical purposes, they've often not been considered in detail. And if you get the wrong code, this could lead to an over or underpayment of duty. For imports into the UK government has announced a temporary import tariff that would apply in the event of a no-deal Brexit. This eliminates or reduces duties on many goods in order to protect consumers and would apply for up to 12 months following Brexit. What's often overlooked is that this means that there's a reduction in tariffs on non-EU imports. So that would mean that UK industry could face more competition from cheap imports from countries like China, for example. This just sets out the the goods that are subject to UK import duties under the UK temporary import tariff, and you can see there the types of products that are subject to duties. Now those are just the headings. You need to look in detail under those headings at the relevant commodity codes, duty rates and quotas.
Hi everybody, now we're going to look specifically at the VAT treatment of imports into the UK post-Brexit. Firstly, in the event of a no-deal Brexit, the UK government has announced it will introduce postponed import VAT accounting so that UK VAT registered importers may continue to account for VAT on goods imported from the EU on their UK VAT returns, rather than having to pay this when the goods cross the border. Businesses will then, subject to normal recovery rules, be able to recover this import VAT on the same VAT return, meaning this will in effect only be an accounting entry. Therefore, in practical terms, UK VAT registered businesses will continue to treat imports from the EU the same way as they do at present. This will remove any cash flow disadvantages of accounting for import VAT at the point of entry, which is good news for all businesses. This postponed VAT accounting will also apply to imports from non-EU countries and not only to EU imports. If your business is not VAT registered in the UK, you'll have to declare and pay import VAT when the goods arrive in the UK. However, HMRC have recently announced a scheme that will allow non-UK VAT registered businesses, which are based in Northern Ireland, to pay import VAT quarterly instead. A special scheme has also been introduced in relation to parcels sent by overseas businesses. In the case of a no-deal Brexit, VAT will be payable as goods enter the UK as parcels sent by overseas businesses. For parcels up to and including £135, VAT will be accounted for using a technology-based solution. It will be collected from the overseas businesses selling the goods into the UK. These overseas businesses will charge VAT at the point of purchase and will be expected to register with HMRC's digital service and account for the VAT via this online account. The aim is to ensure the process of paying VAT on parcels does not become burdensome for UK consumers and businesses. On goods worth more than £135 sent as parcels, VAT will continue to be collected from UK recipients in line with current procedures for parcels from non-EU countries, so no changes will be required in these situations. Changes are also expected in terms of distance selling. Changes will apply when businesses sell goods to non-VAT registered EU consumers via online and mail order sales, i.e. distance sales. At present, distance selling rules apply, meaning businesses often have to charge the local VAT of the consumer's country of location. However, post-Brexit, these rules will no longer apply to UK businesses and they will be able to treat these supplies as zero-rated exports. Depending on the terms of contract, this could then trigger customs duty and VAT implications at the point of arrival in the UK, and this is something businesses will need to consider. In general, we would advise businesses should now be reviewing their supply chains and determining how the VAT treatment will differ if no deal is reached by the 31st of October. As mentioned, in terms of the distance selling and in other situations, businesses may have VAT registration obligations in other EU countries and should prepare for these as soon as possible to ensure a smooth continuation of supplies to EU customers. Now looking at exports, if your business is involved in supplying goods to EU countries, changes will also apply. Currently, these types of supplies are treated as zero-rated EU dispatches, but will, in the event of a no-deal Brexit, become zero-rated exports. There will be a change to the evidence required to zero-rate these supplies. However, this will be very similar to what is currently required. In this situation, businesses will be required to ensure goods are exported within 3 months. They are required to obtain official evidence of export. This could be something like a sea or airway bill, and they will also be required to obtain supplementary evidence of export such as sales contract or sales invoices. As a practical matter, we would now advise businesses to ensure their systems are set up to obtain and retain this information following a no-deal Brexit. Good news for businesses is that businesses will no longer be required to complete EC sales lists on these sort of supplies. In terms of these exports, once these goods enter the EU country of destination, they will be treated as EU imports with associated import VAT and duty becoming due. As mentioned just before, businesses should review their supply chains and the current contracts to determine the obligations they may have in EU member states in these situations. If a business is found to be acting as the importer of record in the EU countries, they may be required to register for VAT there. Now looking at the supply of services, there are also some changes that will need to be considered. If your business supplies services, the main place of supply rules will remain the same post-Brexit. That means if you're used to selling to business customers, there's not really going to be a lot of change, and the B2B business rules will apply. The main area of change in terms of services will be whenever businesses are supplying digital services to non-VAT registered customers in the EU. Currently, the VAT rules regarding this means that VAT is due where the customer resides. Many businesses currently avail of the UK's mini one-stop shop, or the MOS simplification, which allows sellers to account for all such EU VAT on a single UK MOS VAT return. This prevents the businesses having to register for VAT in each EU country in which sales are made. However, after Brexit, this scheme will be removed and you will no longer use this to account for VAT. HMRC has recently announced that the final VAT return period for the UK VAT MOS system will be the period ended the 31st of December 2019. And on this return, you should only include sales made before Brexit. For sales made after Brexit, the business will need to consider which approach they will take. There are two options in this scenario. You can either register for the VAT MOS scheme in another EU member state, or alternatively, you can choose to register for VAT in each EU member state in which you sell digital services to. If you choose to register for the VAT MOS scheme in another EU member state, you'll have to register by the 10th day of the month following your first sale to an EU customer after Brexit. For example, if you make your first sale after Brexit on the 12th of November, you must register by the 10th of December. It's important to note that this cannot be done before Brexit, so nothing can be done currently, but it is something that should be done as soon as possible after a decision is made. It's also worth noting that the digital services threshold will also no longer apply to these supplies. Finally, in terms of VAT, the last thing we will look at is EU VAT refund claims. If the UK leaves the EU without an agreement, then UK businesses will no longer have access to the EU VAT refund system. Currently, if a UK business is claiming VAT in the EU, they can use the system through HMRC. If you're making a claim after Brexit, however, each EU member state will have its own process for refunding VAT to businesses based outside the EU. You will need to consider the process in each EU country in which you're considering making a claim and determine how best to approach that. For EU businesses claiming VAT from the EU, you must follow the manual processes for businesses outside the UK. The electronic system will no longer be available, and you will not be able to make a claim as if you were an EU business. In this scenario, there are differences in the claim process. For example, the claim period is different, the submission deadlines are different, so the businesses at the minute should consider this. We would advise that all such claims are submitted before the 31st of October in order to avail of the current system.
Let's now turn to look at the considerations that will apply for trade across the Northern Ireland border. So from a customs perspective, the UK government has said it would not apply customs formalities or duties on most goods coming into Northern Ireland from the Republic of Ireland. However, declarations would be needed if you're moving a limited number of controlled or licensed goods or goods subject to excise duty. But these special rules would only apply for a temporary period. The UK has also said that if you move goods through Northern Ireland with the purpose of avoiding customs duty, then through Northern Ireland on to Great Britain, then the UK tariff would apply, although there are no detailed rules on this yet, and it is not clear how it would be enforced. These special arrangements, however, are unilateral on behalf of the UK. They are not reciprocal, and so imports into Ireland from Northern Ireland would still be subject to customs duty and controls in the EU. From a VAT perspective, the UK VAT rules would continue to apply normally to VAT registered businesses importing goods into Northern Ireland. And so, as my colleague Stephanie has explained, that Northern Irish businesses would apply the postponed import VAT accounting rules and account for the VAT on their VAT returns. Let's now turn to look at the customs special procedures that could apply after Brexit to mitigate some of the tariff impacts. We're going to talk about a number of special procedures, which includes inward processing, outward processing, customs warehousing, temporary admission, end use, and also the transit procedure. Now these can cause duty suspension, which leads to improved cash flow, but can also result in absolute duty savings. And authorisation is normally required to use most of these procedures, and in some cases you will also need a Customs Comprehensive Guarantee, or CCG. Post-Brexit, there will be separate EU and UK customs territories, and so we need to consider these procedures from both perspectives. The UK has largely replicated the EU's customs procedures in its own post-Brexit customs code. Let's first look at inward processing, or IP. After Brexit, this would allow goods to be imported into the UK under duty suspension for processing broadly defined. If the end product is then exported outside the UK, there is total relief from duty and VAT. If the product is released for circulation in the UK, then duty or VAT is normally paid on either the originally imported raw materials or the processed end products, which can lead to a duty saving. Inward processing could also be used in the EU in relation to UK goods. Outward processing relieves customs duty and import VAT where goods imported into the UK have been produced from previously exported UK goods. And this also provides total or partial relief from the duty or VAT. OPR could also be used in the EU where goods imported into the EU have been produced from previously exported EU goods. Customs warehousing, you can either have a private customs warehouse or a public customs warehouse containing goods from a number of different traders. This is normally a physical location, but can also in some cases be a stock control system. This defers payment of any duty and import VAT where the goods are imported from outside the UK until the goods are removed from the warehouse. If the goods are If the goods are eventually released for free circulation in the UK, then duty is payable, but there's a cash flow advantage. But if the goods are re-exported, then no duty is payable, and so there's a duty saving. And a customs warehouse could also be operated in the EU. Temporary admission provides relief from import duty where goods are intended for re-export after a specific use. Normally, under the temporary admission procedure, no alterations or processing of goods is allowed other than routine maintenance. A maximum period applies, which is normally 24 months. The precise rules vary depending on the type of good, but this procedure can apply to, for example, professional equipment, goods for testing, samples, goods to be exhibited, and scientific and medical equipment. The end-use procedure allows favourable rates of duty for specific industries. It applies, for example, to military equipment, aircraft, shipwork goods, fish and cheese. Let's now go on to talk about the common transit procedure. There's also a so-called union transit procedure in use in the EU, but we're not going to cover that today, as we're looking at the post-Brexit position. The UK has joined what's known as the Common Transit Convention in readiness for Brexit. This applies to the EU countries, also the EFTA countries, Turkey, North Macedonia and Serbia. The Common Transit procedure allows goods to be moved under suspension of customs duties and means that customs declarations will not be required at each border crossing. So this would apply, for example, to goods moving from, let's say, Ireland to the UK and then to another EU country, and would therefore avoid the tariff arising in the UK, and also potentially another tariff hit arising when the goods are re-imported back into the EU. In order to use the Common Transit procedure, you have to make electronic declarations through what's known as the New Computerised Transit System, or NCTS. And goods must be accompanied by a transit accompanying document, or TAD. You could also apply for simplified transit procedures to become an authorised consignor or authorised consignee. Broadly, these enable transit movements to start or end at the trader's premises.
Another point we would encourage businesses to consider is regarding Authorised Economic Operator or AEO status. This is an internationally recognised quality mark, also known as Trusted Trader status. Certification is available where businesses meet standards relating to safety and security, systems to manage commercial records, compliance with customs rules, financial solvency, and practical standards of competence or professional qualifications. In terms of these statuses, a business may apply for either AEO status, Customs Simplifications, AEOC, or AEO status, Security and Safety, AEOS, or both of the above. These applications must be made online, and AEO status can take up to 120 days to approve. So we would encourage businesses who are considering this to look at this as soon as possible. Looking at each in turn, both have their own benefits. The benefits of AEO status include reduced frequency of physical customs checks and potential fast tracking of consignments through customs controls, and also potential international recognition of AEO status in all countries where mutual recognition agreements have been signed. In terms of the benefits of AEOC status, these are the guarantee of waivers or reductions and also quicker access to some customs simplified procedures.
Let's now go on to consider the impact of Brexit on the EU's free trade agreements. So this slide shows whether the EU currently has an applied preferential trade agreement. And you can see there the countries that are covered as well as the countries that are themselves in the EU and customs union. So EU membership brings access to over 50 free trade agreements or FTAs providing for preferential duty rates. The UK government has been trying to replace these EU FTAs with non-EU countries with new bilateral FTAs, although it has had limited success to date for various reasons. Under free trade agreements, rules of origin are relevant. Rules of origin are effectively the economic nationality of the goods and are relevant where you're applying for the preferential rate of duty. Normally, you have to show that the goods have the origin from the relevant country in order for the FTA to apply. So one point that's worth bearing in mind after Brexit is that UK content will no longer count towards EU origin. This may be relevant, for example, to EU businesses that are exporting goods to FTA countries where components are from or processing is done in the UK and no significant processing is done in the EU. However, depending on what the UK negotiates in its bilateral FTAs, it's possible that UK content may count towards UK origin. So finally, what should Northern Ireland businesses do now to prepare for Brexit? Firstly, consider how you will submit import and export declarations and comply with transitional simplified procedures. As discussed, determine your commodity codes and tariffs that will apply both on imports to the UK and your exports to the EU. Consider who will be responsible for import formalities and duties in your supply chain, whether that's you or your customer or your supplier. Look at the terms of your contracts. This may require changes to contracts if you have the opportunity to do so to ensure that you're contracting on terms that your customer or supplier are responsible for import formalities and duties. If you wish to act as the importer of record into EU countries, perhaps to deliver a duty-paid product to your customers, then you may need to be VAT registered in those countries and have an EU EORI number. Also think about applying for those customs special procedures and reliefs we've discussed, and consider the VAT changes that Stephanie mentioned. Also consider the fact that as we leave the EU, you're going to be losing access to those free trade agreements I mentioned unless the UK has replicated them, and consider what impact that could have on your non-EU trade. We've now come to the end of our webinar on getting Brexit ready in direct taxation. Thank you for listening.